All right, so we're looking at the receivables control account, or also called the sales ledger. Okay, as I said, you wouldn't want in your financial statements to put everybody's name, everybody who is owing you, yeah, putting their names there. Okay, so instead of doing that, you just this is the purpose of the control account. You are collecting everybody that owes you money and putting them, you're totaling up what is being owed to you. Okay, so we have a question here with some transactions here, and we have to prepare the receivables control account or the sales ledger. Okay, so here the secret: if the money that is being owed to you is increasing, you debit. If the money that is being owed to you reduces, then you credit. All right, so we start. Okay, we have our opening balance. So since this is an asset account, the opening balance is going to be on the debit side. Okay, so here we're going to put here debit and credit. Okay, so we're going to say opening balance brought down 13,500. Okay, this is what was being owed to us last month, and it comes in as our opening balance for, since we're doing uh, February, excuse me. Okay, so this is the opening balance in February. So we'll go to our first transaction here. Credit sales. So colleagues, credit sales, does this increase what is being owed to us, or does this reduce what is being owed to us? Yes, it increases what is being owed to us. So we debit. Debit side, okay? So credit sales here, 12,500. What is being owed to us has increased. We sold on credit, so more people are owing us money. So we debit there. Next, we go to cash payments. People who are owing us have paid. Okay. So when people who are owing us have paid, it means it reduces what is being owed to us. Okay. So cash payments are going to go on the credit side. Okay. Because it's reducing what is being owed to us. Okay. We have discount allowed when we give our customers a discount. Okay. Customers who purchase on credit to us, they're owing us money. So they are paying us now, and we've given them a discount. So this discount is also reducing what is being owed to us because we're getting less money when we get paid. Okay, so discount allowed also goes on the credit side because it reduces what is being owed to us. Even this rebates, okay, rebates also like they're also like discounts. Okay, you get into a contract with somebody, you tell them, okay, buy this amount of goods from me and I'll give you a discount. Okay. So rebates also are like discounts. Okay. So they'll follow the same principle. They will also reduce what is being owed to us. Okay. So usually in a question, it's either you see rebates or you might see discount allowed, or sometimes you might see them both. But just remember they are both discounts. Okay. Yes. Bills receivable. Whenever you hear this word receivable, it means what is being owed to you. Okay. Customers are owing you some money. Okay. So this bills receivable is increasing what is being owed to us. Okay. If you just hear this word receivable here at the end, whatever you they might put other things, even maybe it might be interest receivable, commission receivable. Just by the fact of this receivable word here, it means this money is being owed to you. Okay. So bills receivable increase what is being owed to us. Sales returns. Customers have brought back goods to us. We sold goods on credit to our customers. Okay, for example, a customer came and bought goods worth 1,000 from you. When they buy the goods, they go home, they find goods worth 300 are damaged. So they return those goods. So it means what that person is owing you reduces because they've returned some goods. So they can't owe you a 1,000 when they return goods worth 300. It means they're now owing you a 700. Okay. So sales returns reduce what is being owed to us. So it goes on the credit side. Dishonored check. Remember how a dishonored check works? All right. A customer pays you by check. Okay. They pay you by check. All right. Let's say they were owing you a 1,000. Then they pay you by check. Okay. They give you a 1,000. So you initially credit this customer to say, they've paid me, so they're not owing me anything. So you've initially credited them. But when you take your check to your bank bounces that check and tells you that this check has got insufficient funds. So once you hear that it has insufficient funds, it means the customer is still owing you, right, colleagues? So, so since initially you cancelled this out to say he wasn't owing you, but then you find out that now he's actually owing you. So you bring back the 1,000 on the debit side to say that you are still owing me a 1,000. Okay. You embarrassed the person, they go to the bank and they have been told the check has bounced. So if it was me, I would even add an interest. I would even add interest there. Wouldn't you add interest, colleagues? Someone gives you a dishonored check, you do that transaction there, to find, then you go to the bank to find the insufficient funds. You have to be compensated for your time and obviously transport money. All right, contra settlements. As I said in our the previous example there, it's a situation where you're owing somebody and somebody is owing you. All right. So you cut off a certain amount, and this contra settlement reduces what you owe the person, reduction in a liability. Also, it reduces what is being owed to you, reduction in an asset. Okay. So on the receivables control account or the sales ledger, the contra settlement comes on the credit side. Then on the payables control account, it will go on the debit side because what is being owed and what is owed is reducing. Reduction in an asset, reduction in a liability. Okay. So in questions, because questions I like to combine these things. So whenever you see contract settlement in a question, just know, well, the question asks you to make the payables control account and the receivables control account. So since the contra asset is dropping the liability and the asset, so in the receivables control account, it goes on the credit side. Because remember, reduction in an asset, you credit. And on the payables control account, it's going to go on the debit side. Reduction in a liability, you debit. Okay. Yes. Bad debts. Okay. Bad debts. This is where people are owing you money. Maybe they pass away, they go bankrupt, their businesses close. So it means you've lost money. You can't get this money back. Okay. So this reduces what is being owed to you because the person has gone away. Probably they've passed on or their business has closed. So you can't chase this money. Okay. That's what bad debts are. Okay. Yes. Bad debts recovered. This is where now you've managed to find one of the people, and or maybe let's say one of the person who was owing you went bankrupt. So you assume they won't be able to pay you. Then they get back on their feet and they pay you the money. Okay. Or not pay you the money, but they are now back in business. So it means what is being owed to you increases now because these bad debts have been have been recovered. Okay. So it's just the opposite of bad debts here. Bad debts go on the credit, bad debts recover to go on the debit side. So what is being owed is still there now. Refunds to customers. Okay. This is where a customer overpays you. So since the customer has overpaid you, it means you're now owing the customer. Okay, you are now owing the customer like this. Let me use the T account. A customer owes you, let's say, 1,000. Then they come to pay you. Okay, so they overpay you. Let's say they overpay you 1,200. Right. So since they've overpaid you, it means he they you are owing them an extra 200 because you're supposed to pay 1,000, but he's paid you 1,200, meaning he's overpaid you. Meaning you are now owing the customer. From a receivable, he's become now a payable. Okay, because he overpaid. So since he overpaid from a receivable, he's become a payable. Okay, so it means you need to pay this person back their 200. So in order when you pay them back, so that you clear the account, the refund goes on the debit side here. Okay, you are reducing what you owe the customer because of an overpayment. Okay, you are reducing what you owe the customer because they made an overpayment, and from a receivable they become a payable. You see? From a receivable they've changed into a payable. So it means to reduce that payable, you debit. Okay. From an asset they've become now a liability. Then finally, interest charged. Your customers have taken long to pay you. So it means you have added some interest. So what is being owed to you increases. All right. So now we can balance off our account. And so we get the totals of both debit and credit. So let's get the debit total. Can someone get the credit total as I'm getting the debit total? 13.5 plus 12.5 plus 900. So on the debit side, it's 27,820. On the credit side, has anyone got the credit total? 8,000 plus 800 plus 700 plus 2,200 plus 500. 12,320. All right. So since the credit side is the lower side, so you're going to say on the 29th, since, oh, it's the month of what? June. On the 30th of June, balance carried down. You're going to say 27,820 minus 12,320. So the balance carried down. You get 15,500. Okay. So on the 1st of July, 1st July, you're going to say balance brought down 15,500. So in short, this is what is being owed to you by your customers.